The era of ultra-low interest rates is over. Central banks, led by the U.S. Federal Reserve, have raised rates at a historic pace to combat inflation, triggering the bond market's collapse. Understanding this dynamic is crucial for navigating the uncertain path ahead.
The bond market is deeply intertwined with the real economy. It influences mortgages, car loans, business borrowing, and underpins pension systems and insurance companies. When the value of these core assets plummets, it creates solvency issues that can't be ignored.
This is not a minor correction. It's a fundamental repricing of risk and money, with profound implications for the global economy. The worst bond market downturn in modern history is challenging long-held assumptions about portfolio construction and risk management. For nearly 40 years, falling interest rates pushed bond prices higher, creating complacency. The recent sharp reversal has shattered that illusion, leaving many unprepared for this new, volatile environment.
A seismic shift is occurring beneath the surface of the global financial system, this time in the vast foundational realm of the bond market. For decades, bonds were the epitome of safety and stability, the reliable anchor in any investment portfolio. Yet this bedrock has been violently shaken. We are witnessing losses on a scale not seen in generations, erasing trillions in value.
The bond market is the bedrock of modern finance. When it cracks, the entire economic structure is at risk. The stability we once took for granted is now being severely tested. Everyone is affected, directly or indirectly, by what happens in the bond market. Even if you don't own bonds, their performance affects your borrowing costs, pension health, and government finances. Pension funds and insurance companies rely on bonds for predictable income to meet long-term obligations. When bond prices fall, the value of these institutions' assets drops, threatening their ability to meet future payouts. The bond market is the foundation for all credit pricing. Bonds are essential for funding public projects and corporate growth, but their influence goes much further. The interest rates on government bonds, especially U.S. Treasuries, set the benchmark for nearly every other loan. Mortgages, credit cards, student loans, and more. To grasp the crisis, you need to know what a bond is, a loan to a government or company, with regular interest payments and repayment at maturity. The bond market now faces a fragile demand picture, with fewer buyers and more debt than ever. This imbalance is at the heart of today's turmoil. The consequences are rippling through the entire financial system. The result? Traditional buyers are stepping back as supply increases, creating a dangerous imbalance. Pension funds are shifting to specific long-duration bonds, not necessarily the broad range of new government debt. Domestic buyers like banks are also pulling back due to regulations and losses, just as government borrowing needs soar. This has caused the value of older bonds to plummet. Major foreign buyers like China and Japan have reduced their purchases of U.S. Treasuries, removing a key support. When rates rise, existing bonds with lower coupons lose value. No one wants a 2% bond when new ones pay 5%. Post-pandemic inflation, fueled by supply chain issues and government stimulus, forced central banks to raise rates at the fastest pace in decades. The bond market crisis is driven by two forces: stubborn inflation and aggressive central bank rate hikes. When the world's largest bond market struggles to sell its debt, it's a major concern. The market may be struggling to absorb the sheer volume of new bonds being issued. This problem will only grow as deficits remain large. Government bond auctions are also showing weakness, with tepid demand and higher yields than expected. Such downgrades can force some investors to sell, and may eventually push government borrowing costs even higher. Credit quality is eroding. Fitch downgraded the U.S. government's credit rating, signaling rising fiscal and political risks. Persistent inversion reflects deep pessimism about the future and a lack of confidence in a smooth economic landing. The yield curve is now deeply inverted. Short-term bonds yield more than long-term ones, a classic recession signal. This inversion squeezes banks' profits and tightens credit for businesses and consumers. Stress in the bond market is showing up in several warning signs. Navigating this new paradigm will be the central challenge for policymakers, investors, and households for years to come. The tailwinds that once lifted bonds are now headwinds. This is a fundamental change, not a passing storm. We're entering a new era of higher inflation, geopolitical instability, and fragmented global markets. This isn't just another market cycle, it's a structural regime change. Even balanced portfolios have suffered, with bonds and stocks falling together, leaving savers with nowhere to hide. Pension funds face new challenges, as volatility and losses threaten their ability to meet future promises. Companies are cutting back on investment and hiring due to higher financing costs. Car loans and credit card rates are up, squeezing budgets. Mortgage rates are at their highest in decades, freezing the housing market. The consequences of this turmoil are real. Borrowing costs are surging for households and businesses.